Thanks for coming and listening to this blockchain. I'm delighted to host this new session of the Scottish blockchain and spread this blockchain knowledge across Scotland. I'm also delighted to talk about something which has been a big shock for me when I discovered blockchain. This was and smart contracts. It was about end of 2014, and my background is pretty much in capital market, and I was working on systems in the derivative world. This is something I'm going to talk about today, and I discovered this technology, seeing the potential of this quote programmable money or smart contracts, and felt that this was really fit for purpose for the derivative market. So I started then to work in the place I was working with at that time. I started to work on projects, writing white papers, stuff like this. Didn't go through so well, so I started this on my own before joining Avaloq and continuing this journey. So yeah, maybe some words about Avaloq, because we are not so well known in the marketplace, at least here. So just for you to understand who we are. So we are a fintech, but not a very young one, in the sense that we have been created in '85, so quite a while ago. So we've been in the business for more than 30 years. We are pretty much in the private banking industry and wealth management. So you see the figures. We have a number of customers, quite impressive in that field, in that niche. We have 2,200 employees around the world. We generate more than 500 million revenues, and we have something we are very proud of is the billions of assets which are run on our platforms, which is quite significant, as you see here. More than 3,000. It's quite significant. We implement a lot of projects. We are very proud of our success rate in implementing projects. That has been very successful so far, and we are spending a lot of effort on innovation. As you see here, we are spending something like 50% of our revenues on innovation. To introduce the topic I'm going to talk about tonight, just to kind of frame what the industry we are in. The banking industry is facing big challenges, as you may know, and these are the four big challenges we face in this industry. So digitalization is the industry is completely transformed with digitalization, and you see the figures here. Debranching is pretty strong. You see this from your daily life, I assume, when you go to a branch. My branch has been closed, for example, and I'm sure I'm not the only one. Mobile is also very strong. Billions of people are using mobile those days for banking, so it's a very, very heavy trend as well. So yeah, digitalization. Something which is not yet happening completely, and you can refer to what Bob was saying before, is digital assets. They are not yet, all these things are, even if we are talking about digital transformation, for me there's kind of a next wave to come, which is having more digital assets, more native digital assets. We just have Bitcoin for the time being, but we don't have a fiat currency available digitally. We don't have bonds or digital financial products. So I'll come to this later, but this is going to influence the digital transformation even longer, I think, on a longer term. New business models. So the fintech world, no need to speak in particular here in Scotland, because the Scottish government is pushing this very diligently, trying to create a fintech hub. So billions of money have been poured in fintechs over the last 5-10 years. So it's really disrupting core businesses for banks. Regulatory is also something which is really impacting very severely banks. They are spending something like 30% of their costs on regulation. So since the crisis, things have changed tremendously regarding regulation, and this is eating margins a lot. So everything they can do in simplifying the regulation is more than welcome. And this is relating also to what Bob was saying earlier. Regulators are very happy about blockchain. They were a bit concerned because of the Bitcoin origin of blockchain, but now this is over. They understand that this is giving more transparency, that this is giving them more control, and hopefully for banks it's also an opportunity to reduce the regulatory cost.
My president wants to help.
No comment. And all of this is leading to a profitability gap, in particular in our industry, specifically in the private banking industry. We used to have high margins that are literally shrinking, divided by 2. So it's a big change. So what we do, we try to support our customers in all those fields. So we have a digital suite which is built on our product. We are, and this is something we are very keen about, we are enabling new business models because we have an API on top of our platform which is enabling fintech to develop additional services, not having the burden to deal about, I don't know, accounting, booking transactions. Those things are done by our platform, and they can really focus on the added value of bringing new services to customers. We also have BPO centers where we operate our platforms on the behalf of our customers. So either we process operations for them or we service the software as a service. So this is a very, it's growing very fast, this area in our company. It has been very successful over the last years. Regulatory is also an area where we are putting a lot of effort to simplify, make it more efficient for our customers, and reduce cost. Well, through what we do up there, you see that the promise is to reduce costs for banks, in particular operating BPOs, outsourcing their operations is helping to get some more control upon the costs. So I'm going to focus now more on why blockchain is so interesting for the financial services. And I'm going to take an example of, I'm going to first describe more broadly what are the things we are doing in financial services, which are introducing some pains, and see how blockchain can fix this, more specifically in the derivative area. So I've presented this slide in blockchain 16 back in November last year. So sorry for those who have already seen this, but I think it's quite important to insist on this problem we have in the financial industry. So when you are transferring money, something as simple as transferring money for a company to pay an invoice overseas, you go through this chain of messages. So you are sending the payer to the beneficiary. It takes 5 days, most often, plus some costs, of course. But so it's a very cumbersome process, very, very old. There are reasons for this, because this has been established centuries ago, and this is how it was, at that time, so to speak. But this is really cumbersome, taking a lot of time, inefficient in one word. Securities market, another sector a big sector of the finance services, not really better. If you see this is what you go through when you buy the securities. So it's overwhelming, isn't it? So you have a number of intermediaries. They all have their function. They are there for a given purpose. But as said Bob just before, you can't disrupt this overnight. I mean, this is a very well-established industry. It has been there for not even decades, but even centuries. So they are also defending themselves, as you can imagine. They have a lot of power, and they are servicing. They are doing some services which are difficult to replace as well. So people like digital holdings, for example, will be successful, but not tomorrow. It will take maybe 10 years for them to succeed in what they want to do, simplifying all this diagram. This is the example I'm going to elaborate a bit more upon. So this is a derivative. So it's a note on the stocks, on the index stocks 50. Very simple payoff. That's why I took this example. And we'll see how blockchain can help and smart contracts can help on that matter. So here it's also a messaging problem, because you have people trading together, sometimes over the counter, so what we call OTC, so not over an exchange, but peer-to-peer transactions, and it's sometimes very difficult to figure out where we are, in particular because there's another complexity in this type of product, which is compared to payments, which payments are, you pay and then you're done. While here you have a product, it has a life cycle sometimes of 30 years. So some of those products are paying coupons or cash flows even every day for many years. So and this has to be kept in sync. We'll see this in a bit. So the main pain point for me is messages, because we are exchanging messages between databases, between systems that are not really connected. It brings a lot of pain to get those systems fully in sync. So when we are transacting between a seller and a buyer, the first thing is the seller is going to write this down in its database or in its system, then send over a message saying, okay, the trade has been done, and the buyer is going also to write this down in its database. And then it's going to send an acknowledge message to say, okay, I've received your trade, and I'm acknowledging this, and the seller is going to write it down in its database as well. The question we have there is, how do we ensure that those two databases are in sync? Because we have a duplication of information. It's not even the same information, frankly speaking, because those systems are very often completely different. So we have the message which is exchanged between the two is a kind of abstract representation of the transaction, so that it can be mapped into the two different systems that are owned by the seller and the buyer. But those have to be in sync, because otherwise there's a mismatch. So how do we ensure this? And of course, as you can imagine, this is a theoretical presentation, so everything works fine. There's no network outage. Database is up and running all time. There's no, but in reality, we all know that this is not what happens. So you may have a problem in the network. You may have a problem with the database. You may have a corruption over time. And so how do you keep these things in sync? So that's why we strongly believe that messages is something which are really creating a lot of pain, creating the need of a very costly reconciliation process. This has been estimated by, I think it was Oliver Wyman. They've been estimating this with Santander and 1 year ago, and they came up with a figure. I don't know really how this has been elaborated, but the figure is quite impressive. They said that the industry is spending something like 20 billion per year to reconcile messages. So it's a 20 billion problem, just to frame it and size it. So main benefits from blockchain would be, first, that instead of exchanging messages, blockchain is introducing what Bob is calling a registry, so a unique database where everyone sees the same thing, and that's crucial to avoid all these reconciliation. So this is the first benefit I see from using a blockchain technology, which is this kind of distributed database. So inherently, the data is kind of centralized, maybe if it's copied internally, but in reality you see only one instance of the data. It's not duplicated, it's distributed. The second benefit we see is moving away from Excel sheets to programmable money. So I will dive a bit more in this in a bit, but for you to know, term sheets in trading rooms are most of the time elaborated through Excel sheets. Traders are, manipulating their cash flow, simulating the product, sending the spreadsheet via mail to the investor. The investor is reviewing this, looking at, and then of course sending it back. And we'll see this in a minute. But so one other big benefit I see from blockchain would be to move away from this and have something a bit more solid with kind of programmable money, in which everyone sees exactly how the terms are. I'm not talking about a contract, but more of the financial terms and the cash flows around the product, and make sure that they are absolutely agreed. And then also, I was mentioning the life cycle. It's also a big burden there. We'll see in a bit how this can be helped by blockchain technology. Maybe a question: who is familiar with those kind of products, financial derivatives? Okay. So I'll go through some explanations. So a derivative, as its name says, it's a product which derivates from another product. Can be anything. Can be a bond, can be an equity, can be weather, for example. And this is then you create a product which is linked, so to speak, with this underlying. We call it underlying. So the product on which a derivative is based is the underlying. The underlying can be a product or can be weather, as I said, can also be an index. In this example, the product I'm talking about is based on an underlying, which is Stocks 50, which is an index in the equity in the euro world. And this has a number of the product which is created is kind of synthetic. So you can tweak the product to do different things. In particular, you can hedge a position. So you can create a derivative which is preventing or which is compensating any move on your portfolio. So if you have a position in one, let's say in one stock, you feel that you have a risk there, you can hedge that risk using a derivative, which is taking the opposite position. Maybe not fully hedged, depending on what you want to do, but this is a way to reduce the risk. You hedge your risk with a derivative. It's also used, of course, and this is the main use you see in the newspaper, for example. You can use this as a speculation tool because normally you have a quite huge leverage on those products. So if you invest 1, you may get 20 or more, or 5, depending on how the product is built. But there's a huge leverage possibly on those products. Sorry. Yeah, and so this is a very, very big business. It's attracting a number of investors for now 2-3 decades. It has been really, really successful. And it has also come into the retail world, because those products packaged like this are available for individuals as well. And you've seen this also in the press very recently. It has been refused by the SEC, but some companies are willing to create an ETF, which is a kind of derivative on Bitcoin. This is typically something you do with derivatives, because for example, weather, you can't really buy or sell the weather, but you can create an instrument which has an underlying as weather. Same for Bitcoin. For people not willing to buy and sell Bitcoin for any reason, because they don't want to bother with keys, or they don't know how to do it, they could, if this would be agreed, they could buy or sell an ETF, which is a tracker, which will give the performance of Bitcoin without buying the Bitcoin. So these are typically derivatives. In this example, this is a very the payout of this derivative is very simple. I'm not talking about how this is built. It's another story, much more complex. But for the customer, it's a product which is basically giving the performance of the index in that range. So if the index is not performing from -20 to -100, you get that performance. So you lose money significantly. If the index, so the index here is Stocks 50, so it's a compound weighted index of the 50 biggest capitalization in Europe, so large companies, which is kind of representing the market in Europe. And if this index is performing between 20 and this product has been set with a return of 7.6%. If the index is performing over the time between the issuance of the product and its maturity, if the difference is between -20 and 7.6, you get 7.6. So it's kind of securing a return, even if the index is not performing so well. And if the index is performing over this 7.6, then you get the full benefit of the index. So up to whatever it goes, 40. So like if you were owning the index itself. So this is kind of performance you may get in derivatives. So here you have the formula for the cash flows, pretty simple. So you calculate the performance, which is the final level of the index minus, so the percentage minus the initial level divided by the initial level. You get the performance in percentage. And then then you pay depending whether this event you've been in this range or in that range, you pay either the performance or 7.6%. So it can be very interesting for even for individuals. And this kind of product have been in the marketplace for quite a while. But as you can imagine, they are not so easy to manage for the banks. So let's put our shoes as an OTC trader for a while, negotiating this type of product with an investor. So the seller is the bank, the buyer is an investor, like an insurance company or an asset manager. And yeah, sorry, something is going wrong. Yeah, no. So what happens there is that we go through a number of iterations. So the banks very often is thinking of a trading idea, something which is making sense to create a new product, which may be interesting for an investor. Can be also in the other way around, the investor willing to present to its customers a new product. So they talk together and they try to shape the product I described earlier. And this goes through a series of iterations, as you can imagine, with these Excel sheets with multiple versions. And at the end of the day, what happens is that everyone wonders which is the version which has been agreed upon. So I've seen at times people look, going back to the tapes, looking at what has been recorded and find out what was the product finally. So it's very cumbersome, time consuming, and not efficient in one word. So something blockchain could help with is all this repository thing, this capacity to seal transaction, to seal contracts or pieces of information, and an initiative which has been put together in Switzerland by a consortium or a group of investors, OTC Swiss Blockchain. They are trying to do this, trying to secure the workflow between the different participants. So what I've shown you before, this interaction is in fact much more complex. You see what is happening behind the scene with interaction of many more players. In particular, you see here the regulators and authorities which are regulating this market, and they need also to know, even if this is traded over the counter, because of what happened during the crisis, they are looking very, very carefully at all those transactions that are not visible otherwise. So here it's a much more complex diagram than the one we have seen before, and that's why it has been used. It has been interesting to use blockchain technology for that purpose, because you can imagine that sealing transactions, sealing the description of those products is quite important, because then you don't wonder which version is the one which has been validated. Once it's sent over to the customer, the customer can then seal and sign the transaction. This is recorded. So they use Ethereum and IPFS over Ethereum, which is a distributed file system, and this is where they store those transactions. Those electronic transactions are signed and sealed in IPFS, and they have built a bit of technology to make it possible to see some of this, like the regulator is able to see all transactions, and of course the participants are seeing only the transaction they have been doing. So kind of confidentiality, as Bob was mentioning before. It's not a public network. It's between banks. So it's a segregated network. Nevertheless, there's a bit of confidentiality in this to ensure that no one is seeing what it should not do. Sorry. So this is one first step where blockchain could help. It's not that disruptive, because it's kind of mimicking what we are currently doing in the current world, but bringing more efficiency with electronic workflow, sealing transactions, signatures, stuff like this. So third step, after the trade is done, you have to manage that product. As I said, the product is kind of a live product, because it varies upon time, upon market conditions, and so you have to handle this at all time during the whole life cycle of the product. So this is a product where we have two barriers. We are looking at, like the one we had before, -20 and plus 7.6, and you wonder what is happening, and these two barriers are going to be monitored all time. So in the example I was taking before, for the sake of simplicity, this is a product which is looked at only at the maturity, so there's nothing in between. So it's issued, then it runs for a period of time. At maturity, the index is looked at, and then performance is calculated. There are other products which are, as I said before, they have a life cycle which is much more complex, because they have events every day. And so then you have to have monitoring systems that are monitoring market levels, triggering events if a barrier is reached, either on one side or the other, and then triggering triggering different events depending on the barrier. So this is quite difficult to manage. And remember that you have two copies of this, because the seller has one and the buyer has also one. And they are doing exactly the same thing at the same time, looking at the market, looking at the barriers, and implementing the life cycle of those products on both sides. And then, because they will have cash flow to exchange, they will need to reconciliate and to make sure that they have the same understanding of what the product is. So you can feel how cumbersome this is. And you see the 20 billion problem then, I guess. So this is where smart contracts could really bring a disruptive advantage in this industry, because you share, as we said earlier, you share exactly the same characteristics. So the participants in the transactions share the same data. There's no duplication of information anymore. This was the first step we saw earlier. In this second step, you go a step further, because then you implement also the life cycle of the product within the blockchain using smart contracts. And this example, the product is maturing in March, the 19th of March 2014. In this, it's an old product, but you calculate within the smart contract. So this is not Solidity, it's just a fake language, so that you can imagine what it does. I had quite a big ambition for tonight. I wanted to put some Solidity code there, but when I did this, I realized that it was kind of making very blur the message I wanted to convey. So I stick to kind of pseudocode instead. But this would be pretty much the same in Solidity. It would not be so much different. So you calculate the performance at the end, exactly like the formula we have seen before. And if the performance is within the knockout event, then you have a performance which is the 7.6%. Otherwise, you have the performance, the regular performance of the index. And this is how, so imagine that there's a keyword like pay to transfer money from an account, from the bank account to the seller or vice versa. And the termination of the contract, you are done. It's a simplistic approach, of course, but just to understand that it is simplifying tremendously what this industry is doing, because it's done once well, not once, it's done on each machine, but synchronously. And everyone has exactly the same understanding of the product at any time. There are issues, because otherwise this would be already live. And so the first one is, and I'm going to follow up on what Bob was saying earlier, is the size of the ecosystem. You can't do this alone. But conversely, you can't do this when you are too many, because it's very difficult to agree upon something. And so you have to find the reasonable size so that it's easy to set up and still interesting. So kind of compromise between the two. So we believe that smaller ecosystems, either geographically or functionally, will be the first to start productively. And there are some examples of this, not only in other outside of the finance industry, but also inside the finance industry, you can find very small use cases that are about to reach production time. Another aspect of this is consensus and confidentiality. I was talking about this earlier in the Swiss example. They have been spending a bit of time in implementing on top of Ethereum and IPFS some mechanisms to ensure that yet they can see the data, but not all the data, that the regulator is able to see things that the others are not able to see, things like this. So this is a complex, fascinating but complex problem, and we are progressing quite fast on this, I guess. Throughput, we all know that Bitcoin is tremendously inefficient. we are spending like, I don't know, the one or two power plant are supplying the energy which is needed to run the Bitcoin network. So it's highly inefficient, and it's impacting also the throughput. So we can't, 7 transactions per second, which is currently what Bitcoins delivers, is absolutely not sufficient for production. This is way too low, even for the derivative market. I mean, so permission networks is going to develop much more, and therefore proof of work, which has been defined or designed for working in open environment, is not needed anymore. So we will move away from these proof of work algorithm to something which is more efficient, allowing higher transaction rates in the coming. It's already there, but it's not yet in production, but it's coming. Another thing is to prove. So, as Bob said, low contract, smart contract, maybe not the best name for this piece of technology. And how do we make sure that what has been agreed is fully reflected in the code? How do we make sure that there's no bug in this? And so the fact that lawyers have been looking at this is quite important. Another thing we have seen, I think it was 1 year ago, R3 was looking at templating pieces of code so that there's less possibilities of introducing bugs or flaws in the code. So this has been in the past in the finance industry, in particular for derivatives, looking at what happened in the 90s. It was instrumental to have templating for contracts. For an ISDA contract, for example, which is the main contract in that industry, was absolutely instrumental to create that market. Otherwise, it would not have been that big. So I guess that these lessons can be also learned for the electronic version of this. And another thing we see in the two-step example I was presenting earlier, a contract which is a digital piece of paper, so to speak, is not an asset. So you need something more to transform this as a real asset. And so that's why I presented this in two-step, because for me, I think the first example is really managing a contract as such, and the second one is more gearing as transforming this contract into a digital asset which can be traded. But don't mix the two. There are two steps in this. Another problem is connecting to the existing world. As we are not fully digitalized, as I said earlier, we need proxies to access the external world. So you need Oracle for getting feed prices into the blockchain, which is also a question, because do you have only one Oracle and then you are not distributed anymore? Do you have multiple Oracles? Which one you would trust then in the contract? I mean, multiple questions can be raised from there. So, yeah. Another thing is, because we are not fully digital, we don't have a fiat euro, fiat currency, a digital fiat currency, or e-euro or e-pound or whatever. You need a connection to make sure that the payments are done. And you need also to make sure that the money your counterpart is pretending to have is really something it has. So this leads also to collateral. Where is the money blocked into an account or not? If this is the case, then it's really highly inefficient for the counterpart to block that money in the system. So there's a number of things there which are not so simple to solve. The market feed, I touched this already. And then, the validation of the smart contract is, as I mentioned earlier, a very difficult, tricky problem. And the DAO example you made is clearly highlighting that this has to be very carefully done. That's all for tonight. I'm available for any question you may have.